is realistic. So how did us volatility folks really do? We were essentially flat for the year. Why was that? Why couldn't volatility funds make money last year? Well, it's pretty straightforward and simple when you really step back and look at this. You're competing against an unbelievable strategy. A strategy that has a Sharpe of about 3, an 11 vol, a maximum monthly drawdown of 5.6, and a 32% return. So what's this wonderful new strategy that's out there that's causing the volatility folks to really struggle because we can't compete against this? The S&P 500. The S&P 500 last year had a Sharpe of nearly 3. Volatility folks struggle when we try and compete against such a strategy.
Relative deprivation theory describes a very, very robust phenomenon in psychology, which is that as human beings, we do not rationally form self-assessments based on comparing ourselves to everyone in our category. We form our self-assessments based on the people in the same room as us, people who are just around us in our immediate proximity. When it comes to confidence and ambition and motivation and self-efficacy and everything else that makes up for career success, relative position matters more than absolute position. The 80th percentile student at Harvard looks around him and says, I can't do this. Everyone else is smarter than me. The top student at Arizona State says, I am king of all I survey, and goes out and lays waste to the economics world.
I think an important factor is look how long volatility has performed over the last 5 years. The people who've been consistently buying volatility to hedge have underperformed the market significantly, and it's been a huge drag. So I think a lot of it also is sort of buyer fatigue or underperformance in the market. There's just not the demand that there has been, and the sellers have done so well.
If you over-focus on sort of S&P and VIX, I think you miss a lot of the opportunities. We've actually seen much richer opportunities in some ways less developed markets in Asia, which are much more influenced by a retail structured product and not participated a lot by and having a really efficient product like VIX.
When you think about the derivatives markets, even in big markets like Japan and some of the European markets, to compare those single stock volatility markets, for example, to the US it's just not even close. And then go to things like VIX and all the related S&P things. They have VIX futures on the Nikkei. They don't trade. They have VIX futures in Europe. They trade a little. There are some very interesting opportunities overseas, but I don't think you can really compare any international markets to the U.S. in any real way.
Going to 2008, there was always kind of an understood and imagined cap on the volatility around 40. You had a myriad of vol events the prior decade, World Trade Center, financial crisis in Asia, 97, etc. Every single time, vol went to 40. And so the same thing, October 2008 comes along, people see 40 vol, they want to sell it, and next thing you know, it's 80. And they were shocked. What happened? And so, rule of thumbs do break down.
Pick another strategy like equity long short. There's some differences between managers, but broadly speaking, they're picking stocks, long and short. Whereas if I look at the vol space, it's a very wide variety of different things that people are doing. So if I think the managers I speak to are quite different in approach, they can be quantitative, qualitative, more focused on technicals, and also the variation over time as the opportunities move from region to region or different subspaces.
I think the key for us is to leverage our competitive advantage versus hedge funds. Is we don't need to be up every month or even every week. So that changes and allows us to take positions that other people won't. And if there's trades that make sense on at the whole level of the pension fund, then we'll bring it up and we'll size it very big at the pension. So it's okay to pay 2 and 20 if you get juice out of it, and that's very important for us.
The regime shift that we're seeing right now is a very interesting one in the sense that as the price of volatility has generally come down, we started to see the price of long-dated volatility come down much more over the past year than it has in the recent past. And that has fairly profound implications on timing volatility trades. If we go out and we buy longer-dated volatility, there are circumstances under which we can sell shorter-dated volatility to fund that risk and essentially carry this convexity profile at a very low cost. Now, that in and of itself is a very interesting phenomenon, whether you're implementing short volatility strategies or long volatility strategy.
The first thing is to go back on the last 5 years, the post-crisis world. What stands out in policy in the post-crisis world? Unprecedented coordination of monetary policy on a never-seen-before scale, which meant infinite liquidity and what you can think of as central bank-induced volatility suppression.
Any example you ask from me, I'm happy to show you the Asia market alternative where the vol supply makes that equivalent structure even cheaper. So while I strongly agree with Daniel, this downward sloping term structure in US vol is very attractive. There's a number of those vol surfaces in Asia with the same dynamic at much lower vols.
The problem that we have in the system is that the system can produce a lot more than we are willing to buy. We have excessive ability to produce. That happened because of globalization, because of technology. We have a lot of people joined, but we are not willing to buy this amount of what we can produce at this current price. And therefore, this is very reminiscent to what happened early on in history, where Ford discovered that he can make cars very, very efficiently.
If you're in a state of nature and you break your leg, your body tells your brain, don't take any risk because we can't support you. When you get sick, your immune system tells your brain, don't take risks. We can't support you. It makes no sense to have constant risk preferences. There's a number of banks and central banks that build indexes of risk appetite after, the internet bubble, specifically when people were talking about irrational exuberance and pessimism, they thought we should start monitoring these things. And they built these indexes of risk appetites, which show that it fluctuates over the cycle. But the indexes are really weird because what in fact they're saying is the following, that the amount of risk, your risk appetite is a function of two things, your native attitude to uncertainty and the amount of objective uncertainty that there is in the world. And then they say that your native preferences towards uncertainty don't change.
Where is the black swan going to come from, or what are people paying attention to that they should be looking out for?
I think, this is in the economic black swan, I think I would expect to be that you can have a combination of strong growth and a dovish Fed. And I think that I think is something that's obviously hotly contested. We talked about this earlier, but I would think that that's going to be the key over the next couple of years, how that plays out.
I think we do need to get actually a correction in the stock market, and if we get inflation below 1%, and maybe we still get reasonable growth at the same time, that's going to spark a very different dynamic, a very different reaction function from the Fed that I think could catch the markets by surprise. So that could be something that could produce significant volatility that I think people have become very complacent about.